Okay, guys, reading 25. And everyone's asked the obvious question. What's the obvious question as we get to reading 25? Are we going to do reading 26 as well tonight? Okay. The answer is probably not. Okay. But the truth is, by the time we finish cash flows, first of all, I don't know what time it'll be, but second of all, we've done a good chunk of work. Okay, we've covered big stuff. Okay, and what do we still have to cover after cash flows? Ratios, four other little sections, not other four sections. Remember, we've done quite a bit of work already on inventory and assets already, and then taxes and long-term liabilities. Okay, and the last two little sections are on the back end are very, very small. Okay, so we're nicely on track, guys, and let's get moving. Reading 25, understanding cash flow statements, and guys, you can see. Look at the topics. The topics are generally they want more understanding. Okay, look at it's called financial reporting and analysis. You're not in accounts 3 over here. They don't want you to. They're not going to ask you to reconstruct this or that, calculate stuff. It's a lot of understanding as well, which makes it, I suppose, a little more challenging even. Okay, good. Yeah, but I want to do a lot of accounting questions by the time we hit the papers. We know where we are. We can what they expect of us, things like that. Guys, turn accounting into a strong point for you as opposed to something that upsets you. Okay. The statement of cash flows is divided into 3 activity-based sections: operations, operating, investing, and financing. And remember, guys, those 3 sections are what? Operating, ordinary course of business; investing, okay, relating to the acquisition and disposal of assets; and financing is how we paid for it all. Okay, good. Per US GAAP, you look over here, guys. Okay, and what goes under US GAAP, and obviously, guys, part of the key over here is that we need to understand and differentiate between how US GAAP treats cash flow stuff and how IFRS treats cash flow stuff. Okay, and guys, throughout the whole thing, I know I'm boring you to death with this, but we've got to get the differences between how US GAAP treats stuff, how IFRS. There's probably 4, 5, 6, 7. I don't know how many marks are going to be there for the different treatments. It's the different, and the reason that they focus so heavily on it is because they say to you, one day you're going to become an analyst, and if you become an analyst and you get a set of financials in US GAAP, and you need to compare them to an IFRS company, you need to know how to take and subtract and move around the numbers within those financials. So that's why they do focus quite heavily on the differences. Okay, we're looking at just some examples of cash flow classifications per US GAAP. On my operations side, my CFO, cash flow from operations, cash collected from customers, interest, dividends, and proceeds from the sale of trading securities. On the other side, the outflow side, cash paid to employees, suppliers, etc., interest paid, and tax paid. Okay. Moving to investment side, what are my inflows? Proceeds from sale of fixed assets. On the other side, outflows, purchase of fixed assets. On my cash flow from financing, guys, proceeds from issuing debt. Okay. Proceeds from issuing equity. Because remember, what does the finance section look at? How I finance everything. Repayment of long-term. Look over here. Tell me if you like this, by the way. I'm just asking. Dividends. What are dividends doing under financing? And not operations. Do you think it should be there? Okay. So why is interest then in outflows? Are they not both capital providers? Because the only question I'm just getting you to think a little bit. If you look on the inflow section of cash flow from financing, what are your inflows? I get money from who? My capital providers. Who are my capital providers? Debt and equity. So why is interest sitting up here then and dividends sitting down here? Just something to consider. Okay. Whereas US GAAP, remember guys, I've stated that quite clearly, per US GAAP, Okay, interest sits in the operations section, and dividend sits in the financing section. Okay, let's move on. Just keep that in mind. Okay. Sometimes companies enter into non-cash transactions. Okay, if it's a non-cash transaction, it's a barter transactions. Okay, you can come to class here for free, and if you give me free banking services, whatever, no cash is involved. Does anyone else do anything interesting that we can barter with? Nobody. Okay, good. But you happy with that? Because there's no trade, sorry, because there's no cash, I don't record it. Simple, simple. Okay, good. These transactions do however need to be disclosed, and I can either do so in the footnotes to the cash flow or in a separate schedule of items that don't affect cash. Remember what we said over there previously, guys, when we looked at the earlier readings, there's a lot of stuff that may not necessarily need to be directly reflected on the income statement balance sheet cash flows, but you do need to report them in the notes. And what's the MD&A section? Management, discussion, and analysis. There's a lot of stuff. Remember that. Please learn that again, guys. There's a lot of stuff that sits over there that does need to be disclosed. Okay, let's go. IFRS typically offers more flexibility than US GAAP. The following table illustrates some of the differences. Let's look over here. And look at this. I'm going to dividends paid. Dividends paid. US GAAP says financing section. What does IFRS say? Wherever you like. Not under investment, because you're not making an investment, of course, that would just be silly. But either one. Interest paid. US GAAP says operations. Again, IFRS says wherever you like. Okay, good. Okay, and then obviously, guys, exactly the same things will apply on the other side when it's not being paid, but it's being received. Again, US GAAP says if it's dividends, see, look over here. Let's clean this up a little bit. Tell me if you think US GAAP is consistent. Dividends received, now they say that it must go to operations. You see that? Interest received, operations. Okay. Okay. It's an interesting one, but obviously they've got their reasons behind it. But just remember that one of the key things, obviously, if you get asked in a multiple choice question, who is more flexible in terms of their cash flow classifications, obviously IFRS is significantly more. Okay. Bank overdraft. How do you treat a bank overdraft, guys? IFRS says it's not a bank. It just happens to be a negative balance, doesn't it? But it's still cash. Okay. US GAAP says treat it under financing as a separate line item. Okay. Tax paid. US GAAP says CFO. And IFRS entry number says if you can tie that tax to a specific investment or financing line item, well, you can put it there as well. That portion that relates to that particular line item. Okay. Guys, if you have to learn one thing, you'd learn this table. Okay. This is where some of your questions are going to come from. We look at the format. Remember what we spoke about a little bit earlier on? And we'll look at it again. Direct versus indirect. What do we say? Direct is what? When I start my cash flow with. Remember, under both systems, direct and indirect, the only difference between the two is the CFO section, isn't it? Cash flow from operations. Under direct, it's more direct. I start with sales, cash received from customers, less cash paid to suppliers, and whereas under the indirect method, where do I start? Net profit before tax or EBIT, or something like that. I don't use a direct approach. Okay. Under IFRS, you can use direct or indirect. Remember, it's more flexible. And the US GAAP, in this case, they say the same thing. They prefer direct. Why direct? Because you can see the flow much easier. It's almost like starting from, it's almost a bit like an income statement. You're starting at sales, and you work your way down. Okay. What does US GAAP say? I don't care what you choose. Choose what you like. I encourage you to use direct, but I don't care what you do. But no matter what you choose, you better show me a reconciliation between the two. Okay. Good. which IFRS doesn't ask for such a process. Okay. Let's have a look at the two different methods, guys, direct versus indirect. Okay, we've seen a lot of it before. Okay, I'm going to go straight down here, guys. The major advantage of the direct method, it lists all the sources of operating cash flows and the uses of those cash flows. It says cash received from customers, less cash paid to suppliers, less cash paid to employees. And you can see the breakdown of all of those sources as well. Okay, good. A nice advantage of the indirect method, guys, is over here. Okay, is that you can see a link back to the income statement, because the income statement will often start from net profit before, and you can tie that in, and you can, okay, either approach. Remember, both IFRS and US GAAP, this is the key, allow either method. Yeah. Good. How does the income statement tie into the cash flow statement, to the balance sheet? Okay. The cash flows reconciles opening cash balance to closing cash balance. Okay. And we've seen the three different sections, guys: operating, investing, and financing. Operating is mainly income statement type items. Okay. Investing relates to the firms, generally the non-current assets of the firm. Okay. And financing looks at how you finance it, and how do you, and remember, guys, we know this by now, how do we finance? With debt and equity. You happy with that? There's your links. Okay. Let's have a look at my numbers over here. The standard format for the direct method, and remember, guys, very, very important to remember, guys, the only difference between the direct and the indirect method sits where? The first section, cash flow from operations. Cash flow from investing and cash flow from financing, the same thing under both methods. Okay. And we look over here, looking at the direct method, and you can see, guys, I've set you cash flow from operations only. That's all I'm looking at. Okay, and it's cash receipts from customers less cash payments to suppliers and employees, less interest paid, add dividends received, and less income tax paid. Okay. Cash received, how would cash received from customers, guys, bottom of the page over there, differ from revenue? Chat? You can give a joint answer. Okay. Is that your same point? Okay, so revenue is what revenue is. I work with a concept called matching, don't I? Matching, and what's my other word? Accrual. If the revenue is earned in this period, I must record it. Okay. Cash flow, okay, is what? Cash flow is cash. I don't care when it's for. Okay. A student phoned up the other day and said they want to make sure they book their place. I said, no, it's fine. I'll keep you a place. Don't worry. If I say I'll keep you a place in the class, I will. They said, no, just to make sure they want to pay. Can they pay now for the course that only starts in June? I said, with pleasure. Okay. Why? Cash is king, and cash is cash. You can, I can't go and buy. Sorry, I don't mean to bring up the bread again for Wendy. But I can't go and buy bread with the accounts receivable, can I? Okay. And that's the point. But the big difference, guys, is revenue works with what concept? Accrual, matching, things like that. Cash is what it is. Having said that, how would I get to this number, cash received from customers? Give me 3 line items I got to work with to get you the actual cash I received. 3 line items. Revenue is an important one. You happy with that? But I've also got to adjust upwards and downwards on which 2 accounts? Opening balance, accounts receivable, and closing balance, accounts receivable. Am I right? Because what will that give me? Opening balance, accounts receivable is what? They owed me from last year. Add what I should have had this year, which is my revenue, less what's still owing should give me what? What they've actually paid me. Am I right? Okay. Good. And there's your, you happy with that, guys? There's your, so sales is my 1 line item. Add accounts receivable, because opening accounts receivable, less what's still owing would give me what? What cash I actually collected. Am I right? Does that make sense, guys? Okay, good. Now, when I move down to other items now, let's go for the expense side, guys. Cash payments to suppliers. Again, the same story, am I right? Because cost of goods sold is a matching and an accrual concept, isn't it? It's not a cash item. Again, what I have to adjust for? Opening and closing accounts payable now. Opening and closing inventory. Same story. I've got to say, well, what was actually spent over here? Okay. So a nice easy one to work out here. Cash expenses are cash expenses, if I happen to have any of those. Okay, those are nice and easy to work with on the cash flow. And now look what I do. I add and subtract opening accounts payable, don't I? Okay. And other inflows and things from current assets and from current liabilities will give me. But can you see over here, guys, the minute I start to work with cash received from customers as opposed to normal revenue, I've got to start to adjust for, I've got to start to work with my balance sheet as well, don't I? Okay, and adjust opening and closing balances to get to my numbers. Okay, good. Nice little rule we've got over here for you guys, because they are going to ask you this. If an asset increases, what is that? Cash in or cash out? Cash outflow. You happy with that? Because the asset increased. It's a cash outflow. Okay, let's look at inventory. If my inventory account goes up, what happens? I bought inventory, didn't I? What happens to my cash? Down. What happens to my liability? It goes down. Liabilities go down. Cash? Liability goes up. Sorry, liability goes down. Cash outflow. I paid that liability away, didn't I? I owed you 100. Liability's gone to 50. I paid you 50. Cash went out. If your liability increases, cash in. Good. What's that? Okay. Yeah, it's a lovely point. Shows a good understanding. If the asset that increases is cash and cash equivalents, yes, that's a cash inflow, isn't it? Okay, good. Interest, dividends, or income tax paid. How do I, again, guys, I'm sorry to bore you a little bit now, but how do I determine, guys, interest paid, what is actually paid? Just like revenue, I say, what's the interest expense per the income statement, and I adjust for which two accounts? Opening balance, interest payable liability, and closing balance, interest payable liability. Same old. What do you think is going to change for dividends? Absolutely nothing. I'm just going to change it from interest to dividends, aren't I? And now, guys, can you start to see the interaction between the balance sheet, the income statement, and the cash flow? The cash flow is like, and that's why when you're drafting these items, okay, you go income statement, balance sheet, cash flow. That's the order, isn't it? There's no guys here chartered accountants, am I right? Yeah. Nobody, sure. Okay. And remember, because the final line item in your set of numbers is your cash flow, isn't it? Okay. Because remember, you can't work out a cash flow until you know what your cash is. Where do you get your cash from? The balance sheet. You can't start to, and as we go, obviously you can't do the balance sheet until you've got an income statement, because you need income and you need retained earnings. So it's got a certain flow to it. I'm not doing dividends for you there, because that we've seen already. Income tax payable, blah blah blah. We've seen that already. What's the only thing that's going to make income tax payable worse for you? When you put a D in front of the tax called deferred tax, then it becomes a bit tricky. But that's for another day, probably Tuesday. Okay, either we do it on Tuesday or Thursday. It could even be Thursday. Let's go. Income tax paid is what? I go to the income statement and say how much tax was paid per the income statement. Remember, guys, anything that sits on the income statement is not cash, is it? It's matching, it's accrual. We know these terms already. How do I get to the cash component? Well, I've got to take income statement per income tax per the income statement and adjust for opening and closing income tax liabilities. Okay, good. CFO, cash flow from operations, when I'm looking now at the indirect method, you can see it's not direct, is it? Direct starts with revenues, cash received from customers. Okay, where do I start here? Profit before tax. And then what I do, I adjust for non-cash items like changes in inventories, receivables. Let me ask you this. Tell me what happens here. Okay, I got accounts receivable. Let's start with the easier one first. I got accounts payable of 100. That's opening balance. You happy? I've got a closing balance of accounts payable of 30. Even I can work out the difference of 70. Am I right? Is that 70 a cash inflow or cash outflow? Cash outflow. My liabilities have gone? Yeah, good. Okay. And that's what I'm doing over here on the indirect method, guys. I'm looking at the changes in all of my working capital balances. Are they cash ins or are they cash outs? Okay. There's profit before tax. I'm not spending too much time over there, guys. Change in working capital, we've seen all of those as well. Nothing much more to add over there. Okay. Now we move on. I'm on page 8 now, guys. Everyone comfortable? It's not too crazy. But it's got to keep your head about you over here, guys. Cash flow from investment. Now remember, now that I've gone past the CFO section, cash from operations, it's all the same, isn't it? Direct and indirect, it's the same methodologies. Okay. Property, plant and equipment again, guys. Boring. Look at how do I get to my cash, what I actually bought? Let me ask you this. When I'm looking to get to how much property, plant and equipment I've bought, could I just get it? Let's say, for example, I say to you, okay, look here, opening balance was 100, closing balance was 200. Therefore, what? I bought how much? Is that right? No, why not? What am I missing? Depreciation. Because remember, that 100 opening balance, what happened to it? I didn't only buy 100 here, did I? Let's have a quick look. Let's say, for example, depreciation was 30. So what's happened over here? It's 100. It's not really 100, is it? Because that 100 was really how much? Once I take off depreciation of 30, it's really how much? 70, isn't it? And my closing balance is 200. What did I really buy? I really bought for how much? 130. You happy with that? Okay. That's all over here anyway, guys, but just don't forget to adjust for depreciation in that year as well. Now, how do I work out, because remember, part of my investment section is what? To see how much are proceeds on disposal. Wow, how am I going to get to proceeds now? What's the other thing I've got to take into account? Let's just clean up a little bit over here. Let's have a look. What's the big thing? Look over here, nice and easy. I've got historical cost of the assets sold. I've got that. I've got opening balance, purchases. We work all of that out. What's the key over here, guys, that I didn't show you before is gains and losses on the asset. So once I can work out the gains and losses, then I can work out how much I sold it for. Am I right? Therein lies the big difference. Here's your key. That's the big one. Because it's easy to work out how much was sold. Am I right? The value of the asset was sold was 30. I don't know what. So that doesn't tell me anything, does it? I need to know how much I received for it. Proceeds on disposal. For that, I've got to take into account gains or losses. Yeah. The only way I can work out the cash amount that I received is to adjust for gains and or losses. You happy with that? So, let's say, for example, I sold an item for, I don't know. When I work it out, I get to a number what I sold. But I don't know if that's, I don't know how much I received for it. Okay. All I know is I've taken it off my balance sheet, haven't I? Let's say, for example, over here, if we're just very very crudely. Let's do it the other way around. Opening balance, oops, messing this up a little bit. Opening balance was 100. Closing balance, 0. What would you tell me? I'm excluding depreciation for now just to make it as simple as possible. What would you tell me? I sold assets this year for 100. What did I receive for them? I don't know. All I know is that assets at a carrying value have been removed from my balance sheet of 100. You happy with that? If I made a profit of 50, what did I sell them for? 150. If I made a loss of 50, what did I get? 2050. And the key thing that I'm looking for, guys, is what? For a cash flow statement is proceeds on sale. But I can't work out proceeds until I work with this line item over here called gain or loss on sale of the asset. Okay, and that I obviously get from my income statement. That's the key one that I'm looking for. Okay, cash flow from financing. Okay, non-cash transactions, blah blah blah. We've seen these before. Okay, what if you purchase shares? Sorry, you purchase an asset and you issue shares for that. So no cash what happens? I get the land, or I get the building, and I issue shares. So no cash actually Okay, good. What happens over here in such a case? Equity goes up, am I right? Because I issued new shares, and assets go up as well because I used those shares too. Okay, good. Be careful to take this into account when preparing your cash flow. Even though assets and equity increase, okay, it was as a result of a non-cash event, okay, and must not be included in your cash flow statement. Remember what we said before is just show it somewhere to make sure that you have shown a little bit about these numbers. Okay, good. Here's your cash flow. Look at a little bit of an example over here, guys. Okay, here's your revenues, okay, etc., etc. There's your expenses. And what have you got over there? You've got a normal income statement, am I right? Okay, and you made a bit of a profit this year. There's your balance sheet. Okay, showing you all of that. Now we look at your cash flow statement. Okay, good. Starting off with the indirect method. If I start with the indirect method, I always start off with what, guys? Profit before tax. Okay. Why do I add back depreciation, guys? It's a non-cash item, so I made more. And then I look at what, guys? I'm not going to spend too much. I'm not going to go through each one in detail with you, but I work changing all my items. Okay. 10,800. That's on the indirect method. When I move to the direct method, what do I start with? Cash receipts. Just to spend a minute or two on this, let's have a look at how I got to those cash receipts from customers. Now, tell me what are my line items? I go back. My first one, my starting point will be revenue, won't it? I build revenue of 11.4 million. But what? Okay. I didn't get it all in, did I? There's quite a bit still sitting in accounts receivable. Okay. Just check something over here. What do you notice? Sorry, I should have mentioned this before. This is the first year of operation. That's why there's no closing. So just on those two numbers, I'll try to make it as easy as we can, guys. On those two numbers, if I build revenue of 11.4 and I'm still sitting 2.4 million hasn't come in yet, is my cash inflow from customers higher or lower than revenue? Lower. Because I build 11, but how many guys haven't paid me yet? 2.4. You happy with that? And therein lies your... Okay, we've made it a little bit easier. Let's have a look at your note over here, guys. Let me just show you quick. It's going to be 11.4 that you build, am I right? Less the 2.4 that haven't yet paid, 9,080,000. You happy with that, guys? Okay. I'm not going to go through each one with you guys. Just do have a look at all of those. Let's have a quick look. A purchase of property, plant and equipment. There we go. Now I'm in the investment section. Okay. Purchase of property, plant, and equipment. Again, you can have a look over here. Where would I look for that? Go look at my balance sheet, and look, I've got there's land gets come in, there's buildings, office equipment, all good stuff that has come in. Okay. What's the only thing I must be careful for at the end of the year? Don't forget to adjust for what? Depreciation, goods, proceeds from capital contribution, that's cash in, proceeds from issue of shares, loans, withdrawals, etc., etc. And what's the last bit? What's always the last bit is show me how much my cash and cash equivalents have moved for the year. Add opening balance, which obviously in my case was a 0. And if I look at my balance sheet, what is my cash for the closing balance of cash? I'll cover that up. Is your 8.2. You guys comfortable with that? A very simple little illustration, but worthwhile to have a look through. My advice to you guys is, before we meet again Tuesday, do have a look at just to make sure you can do the cash flow. Start from scratch and just do it. Make sure you can. Always looks a little bit easier when we do it on the board. But start from scratch and just okay. Good. Let's go over the page. And guys, just on page 12, I've given you the detailed workings of each and every line item, just in case you are looking for those. Okay. And I'm not going to go through all of those with you. Okay, is everyone comfortable thus far with cash flows? Not a crazy section again, guys, but can be a little bit tricky. You've got to remember things like when you're working out proceeds on sale of assets, I've got to take into account gains and losses. Purchases, I've got to take into account depreciation. Revenue, all those items I've got to take into account. Opening and closing balances of my accounts receivable, accounts payable, etc., etc. Okay. Let's have a look over here. What do you think you're going to do if you want to get to common size cash flows? Sure. What are common size cash flows? For income statement, what I use? Revenue. For balance sheet, assets. What do you think is going to happen over here? Okay. Over the page. Okay. We'll get to that one in a second. Let's just hold back on that. Okay. And just very briefly, it just talks about okay, on page 14, the following are the main sources and uses of cash. Cash flow from operations, that's what money came in to my business, okay, from normal operations, things like net income, etc., etc. Okay. We've discussed most of this via during the class. Cash flow from investing, we've seen most of the stuff over there. And cash flow from financing, okay, etc., etc. I'm not going to spend too much more time over there. Where I want you to get to, guys, on the bottom of the page is common size cash flows. Common size cash flows, and we're going to keep you in suspense for a little bit longer. There are two approaches when drawing up common size. You can give me the two. Income statement, we said revenue. Balance sheet, we said assets. What do you think's coming? I've got two here. Okay. Revenue, that's the one way. Okay. And each cash flow, okay, to express each cash inflow as a percentage of total inflows. Okay. And each cash outflow as a percentage of total outflows. Okay. So that's, generally speaking, guys, to be honest with you, we're going to use revenue as a base. You think I'm safe using revenue? More or less, at least on the cash from operations side, for sure I'm safe. Okay. Good. But what do you notice over here? Okay. Look over here. When I put some of my items over here, okay, I could have some strange numbers like over 100%, can't I? When will and don't look at this, tell me, when will I have over 100%? When I'm benchmarking to revenue, when what's happened? Good, and what else? For example, what's happened? That my revenue is what? I want the exact answer. What's happened to make that number? Because remember, I'm benchmarking to revenue, aren't I? What's happened if I get a positive more than 100% cash collections? What does that mean? More? You know, you'll never get away with that in this class. Give me more. So remember, let's give you an example. So let's say revenue is 100. Happy with that? I'm looking at this ratio of 106%. And cash received or cash collections was 106. Why did I receive more? More cash than what I billed? That's my question. Brilliant. Simple. Income received in advance. The student phoned and said to me, please book me a place. I'll pay you in advance. I said, brilliant. And they paid in advance. That money, if they're paying now, if a student comes to you now and says they want to pay now for the December program, what would I say? I can't bill that to revenue, can I? Because my year end is June. So what do I do? Income received in advance. Is it cash? Sure, it's cash. Happy with that? And that's why sometimes you're going to find your numbers can be higher than 100% when benchmarking to, even when I'm benchmarking to revenue, which is quite a high number in and of itself. The last question on this particular one before I make you too mad. You're the owner of the business. Do you want 106% or do you want less than 100%? You'd love more than 100, wouldn't you? It means that your customers are paying you ahead of time, aren't they? Okay, and that means your cash is, you should have a healthy cash position. Okay, is it revenue that's earned? No. Okay, well, you'll earn it next period. Just stay in business, am I right? That's your trick. Okay. And there's all your items, guys. I'm not going to spend too much more time on those. But remember, guys, just like we saw with income statements and balance sheets, you can do a nice analysis, can't you? Once you have benchmarked everything to a certain percent, you can say, oh, look at this business. You can pick up some anomalies, things that are a little bit odd. You can say that, go through each one and say, we'll see where the big numbers happened to be. Okay. We look at a little term, and I know you've seen this before, and you're going to see it hectically in level 2, free cash flow to the firm. What's free cash flow to the firm? Where do we see this, bro? This is under the equity section. This is how you value a business, don't you? Okay. Remember, there's two things you can use. You can use, okay, when I'm looking at free cash flows, okay, you can use dividends or you can use free cash flows to value a firm. Okay. And free cash flow, look over here. This is what I want from you guys. Free cash flow to the firm. Who's the firm? Everybody, am I right? All the capital providers, debt, equity, prefs. So if I'm looking to the free cash flow that's attributable to all of them, whereabout am I starting? I've got to work before interest, don't I? Because remember, I've got to say what's attributable to who? All the capital providers, including the debt guys. So I'm working way up on my income statement, aren't I? I'm saying what's the free cash? To who? To everybody, all my capital providers. Okay. And look at the calculation. Okay. Free cash flow to the firm is what? I take net income, but net income is what? It's after interest. I want it before. So you can see straight away I add back interest over there, don't I? Plus NCC. Why am I adding back non-cash charges? I want cash, don't I? Because I want free cash. Net income is taken off what? Depreciation, amortization, gains and losses on assets. I want to add that all back, don't I? Okay, that's step number 2. Why am I taking off, when I'm working out my free cash, why am I taking off investments in working capital, investments in fixed capital? Because I'm looking for free cash, aren't I? In order to make that cash free and available to the capital providers, I've got to make sure that I've put away enough money for what? CapEx and working capital. You happy with that? So these last two over here relate to that part of the definition that says free. These ones, adding back, and look over here, it's free, it's cash flow, and it's to who? The firms. Now let's see where each one fits in. Okay. The fact that it's free, I've got to take off investments and working capital. The fact that I want it to be cash flow, okay, I've got to take off what? Add back non-cash charges. You happy with that? And the fact that I want it available to the firm, number 3, I've got to add back interest from what? Our net income. Okay. Remember, if they gave you a line item that was after prefs, what would I have to do? Add back prefs as well. Okay. And there we go. There we go. If we just have a look over here, we've seen all of that, guys. Can I get to my free cash flow to the firm using CFO? You can, no reason why, but look what happens over here. With CFO, what else do I have to take off? Investments. You happy with that? Because the investment section comes second in the cash flow, doesn't it? I haven't made any adjustments there just yet. Plus interest. Why interest? Because I want free cash flow to the firm. I'm going to take back interest. Where is my non-cash items? Why am I not adding them back? They're already adjusted for in CFO, aren't they? What else is adjusted? So if you compare this one to here, look at the differences here, guys. When I'm working from income statement, there's 2 additional items, aren't there? What are my 2 additional items? Non-cash charges. There's no non-cash charges in CFO because it's already taken them off. As well as what? Working capital as well. Am I right? Working capital comes into the CFO calc. Okay, good. And there's a little calculation. I shan't do too much of that with you guys, but please do have a look at that as part of your homework, just to make sure you can do all of that. Okay. Top of page 18, guys, I moved to this concept called free cash flow to the equity, guys. Why the equity, guys? If it's the equity, guys, what's going to change here, guys? It's free cash flow to who? Just the equity, guys. Look at my adjustments over here. Okay. It's net income. Yeah. I don't have to add back interest because I want interest to be taken off already. I do add back non-cash charges. I do take off fixed capital. I do take off working capital, and I adjust for my net borrowings, the movement in the long-term debt. Okay, everyone comfortable with that? Again, I could use CFO. No problem with that. And again, CFO, what don't I take into account? Non-cash charges and working capital. You happy with that? So remember, guys, very important when they start to talk of FCs. Okay, free cash flow. If it's to the firm, it's attributable to everybody. If it's to the equity guys, it's just for the equity guys. Okay, here's a little example for you as well. Okay, last little bit, guys, before we start ratios. I mean the ratios here, of course, not the whole section. Don't worry. Okay, I saw some if looks could kill looks. Okay, I always keep my word. Okay, if I said no ratios, it's going to be the next reading, which will be for Tuesday. Okay, guys, let's look at cash flow ratios. We look at some of the ratios over here. And the good news over here, guys, is we've seen quite a few ratios on income statements thus far, so quite a few ratios on balance sheets, and now we're seeing some over here. So when we do the ratio section in and of itself, when you see current ratios, you've seen quite a bit before. Okay. We look at first at performance ratios. Now remember, guys, this is where I don't want you learning stuff. Performance means how the company has performed. If I'm looking at performance, what section of the cash flow am I looking at? Operations, how they perform. So you can see, guys, the minute I'm looking at this thing called performance ratios, what's my numerator? CFO. You happy with that? Because I'm looking at the performance. And if I say to you, what's the cash flow to revenue ratio? What's the ratio? Cash flow to revenue. Okay. If I don't learn them all by heart, please. Okay. A lot of it's so it's CFO to revenue. Cash return on assets. CFO to assets. Now, a little bit of a quirk over here, guys. Do you use average assets? In other words, take assets at the beginning of the year plus end of the year and divide by 2, or you just use closing? I don't care. Okay, the question will tell you which way to go. I always tell you about ratios, guys. It's just be consistent. If you are an analyst, don't one year use averages and the next year move back to closing numbers, etc., etc. They're going to laugh at you. Okay, let's go. What's cash return on equity? CFO over equity. I'm boring you now. Cash to income. CFO to income. Okay. Cash flow per share. Ooh. Okay. A little bit of a thing that I like to change over here, guys. They say CFO less pref shares. It depends where you want it to be. Am I right? If you wanted to include pref shares, well, you can leave the pref in. But if you just wanted your own return, because remember, what's my and can anyone explain to me why in this case do you agree with me? I'm to take off the pref shares. I want a clever answer. It's almost going to guarantee your exit tonight. If I get a clever answer. Because I'm still starting to, I'm getting like my second wind. Okay, give me a clever answer. Is that right to deduct prefs? What do you think? What's on the bottom? Common shares. So what am I dealing with? Okay, so on my denominator is just ordinary shares. What do I want on the top then? Or what is attributable to the ordinary shareholders? Am I right? So what must I take off? Debts and prefs. Debt's already taken off, isn't it? Just work on the prefs. You happy with that? Look for the consistency, guys. So if you sit in your exam and you think, they ask me cash flow per share, do I take off prefs? If I know that my bottom is ordinary shares, of course you do, don't you? You've got to keep it consistent. Okay, last bit. What are coverage ratios? How would you describe coverage ratios? Is how secure you are, or how covered you are, am I right? So we look over here. CFO to total debt, what would you like? You'd like it to be a nice big number, wouldn't you? That you've got a lot of cash flow from your operations to be able to cover your debt, am I right? And very important for ratios, I'm not going to do the next section, because I said I wouldn't. But I can talk about it for a second. Okay. And in reading 26, what are we going to see over there, and we spoke about this last lecture as well, is all these ratios are not important or not important in and of themselves. We look at them compared to last year. We look at them compared to competitors. We look at them compared to industry. Okay. That is debt coverage ratio over the page. Interest coverage ratio says CFO, add back interest paid and tax over interest paid. And that ratio, very important, that will tell me, give me my indication of my ability to pay interest. Reinvestment ratio is CFO, how much divided by what you pay for your assets, your long-term assets. Debt payment ratio, and what are you seeing mind-numbingly boring on the top? CFO. Okay, good. Debt payment ratio, CFO over cash paid for long-term debt repayments. And that says, can I pay my long-term debts? Am I able to make those payments? Yep. Because it's the cash paid for that particular repayment. Good. Okay. Dividend payment ratio, blah, blah, blah. Okay, CFO over dividends. Okay, guys, please don't spend time learning ratios off by heart. You must learn them, but not off by heart. I'm not saying to you not to know them. You've got to know them. Okay. The investing and financing ratio is CFO over cash flow from investing and financing activities. Okay, and what's number 7? Give me number 7. 7 is I want the cost of goods financing ratio. Cost of goods financing ratio. Cost of goods ratio. CFO over cost of goods. See, I didn't have to write it down, then you got it. Okay, guys, you've got to use your common sense for ratios. Guys, it is now 9:30. Please don't forget to take a ticket on your way out. Okay, and we will see you guys on Tuesday and Thursday again next week. Hopefully, we will be done with FRA by then. Okay, guys, have a marvelous evening, and everybody, please drive safe. We will see you on Tuesday.